When you see the most well-funded and well-informed traders on the globe, from China to the other central banks to our own Comex, seeing these kinds of deliveries, that nothing else matters. I mean, as crazy as that sounds, you got Wells Fargo sees a potential for gold to move to 8,000 by 2027. UBS, JP Morgan, Chase, Deutsche Bank, and the Bank of America are all targeting 6,000 plus. BlackRock is moving away from their 60-40, as Hartnett had, as has the chief analyst for Morgan Stanley, who said sell half your bonds, put it in gold. This was all orchestrated by margin increases and rebalancing of ETFs. Everything is still in place. You can see it through the deliveries and quietly through the admissions of the banks who don't want to say, well, we told you. On top of all the deliveries, you got the banks saying, yeah, this is where it's going. Now, people wouldn't even notice that because it got collapsed, right? The BIS says this isn't collapse, this is structural. This use misdirection of price, of narrative, of media coverage, of everything. So these things are starting to accelerate when you see removal from the exchanges and really low open interest on Comex. I read an article yesterday, and I like the way they titled it. They called it the Shanghai flip. Now, I've talked a lot about this, how in January, when gold and silver both crashed, a flash crash, you could call it, from its all-time high. Let's start with gold first. In Shanghai, it was trading at a premium of between $50 and $80 an ounce. What that tells me is the exact same thing that the Bank of International Settlements came out and said. And in other words, the leverage speculators were facing massive margin calls because they raised margin rates by 300%, they being the CME group. At the same time, it's like the worst time to have done that because they knew that the first week of January, all of the levered ETFs have to rebalance. And they were way out of whack with the massive rises we had been seeing week over week over week into the end of the year. So you rebalance the ETFs, so you have to sell the stuff to rebalance it. At the same time, they've raised margins. In other words, it was orchestrated is a strong word, but it was structural, not fundamental. The BIS came out and said that. They're like, listen, nothing's changed fundamentally. This was a structural collapse based upon the mechanics on the CME group, the Comex. So with that in mind, this Shanghai flip, the central banks were continuing to buy hand over fist.
Most investors saw a price drop, but almost nobody stopped to ask who was forced to sell and who was quietly buying. As Andy Schectman points out here, a 300% margin hike collided with ETF rebalancing at the exact moment leverage in the metals market was already stretched. That matters because structural liquidations can distort price without changing the real demand underneath the market. When Shanghai still showed a $50 to $80 premium during that decline, it suggested physical buyers were reacting very differently than paper traders in New York. Next, Andy Schectman discusses why that disconnect became even harder to ignore once import data started rising.
But in February and in March, China imported the most silver ever for 2 months in a row. February was the highest month they had ever imported, ever. March beat that. So their silver imports rose by 80% nearly month over month.
What? It almost doubled in a single month?
Yes. And so that was into March. And silver in February was huge, but March was even bigger. And so it's 173% above the 10-year seasonal average for March. So, and go back and look over the years, you're almost 200% above normal to what they normally buy. Their year-to-date silver imports are up to 1,626 tons, the highest on record. Now, this is when silver was getting its teeth kicked in. Yes, absolutely.
So the global rush for physical gold, and especially silver, is indeed seeming to go into overdrive.
In gold, too, the third consecutive monthly increase, China, 17 straight months in a row. But their imports rose to 162 tons in March, the highest since March 2024. Third consecutive monthly increase, higher, 17 months in a row of consecutive stockpiling. So yeah, you got the central banks, and in particular China, who use the stupidity of the CME group's margin hikes by 300%. To at the same time the ETFs were being rebalanced, to say, great, thank you, we will gladly take that subsidy and stand for delivery. The same thing is happening on Comex. You're seeing, massive deliveries on Comex too. We talked about the February. Again, let's look in February. In February here in the United States, when the price got collapsed, you saw 25.5 million ounces delivered on Comex.
The deeper story is not falling silver prices, but record buying happening while sentiment looked weakest. As Andy Schectman points out here, China lifted silver imports by nearly 80% in 1 month and pushed them 173% above the 10-year seasonal norm. That kind of accumulation during a sharp price decline often signals institutional buyers are treating weakness as opportunity, not danger. Retail investors usually react to headlines, but sovereign buyers often respond to dislocations in the plumbing of the market itself. Next, Andy Schectman unravels what those enormous Comex delivery numbers may be revealing behind the scenes.
Nearly 39 million ounces get loaded out, meaning leaving on trucks 2 million pounds, and it left the Comex. 2 million pounds on trucks. Who's taking that and where is it going? This is the same thing we've seen every single month. And that is the story that the mainstream has missed, Adam, is that price, all of the things around it are distractions, misdirections. What betrays everything are the deliveries and really the loadouts, meaning it leaves Comex. And when you take 39 million ounces in 1,000-ounce bars, which each 1,000-ounce bar weighs 60 plus pounds, and you're taking closer to 70, you're taking 39 million ounces and putting it on semis and driving it out of the ecosystem, they'll never come back. They would have to be drilled and assayed to get back in there. That's a sophisticated to the nth degree investor. That is a wealthy to the nth degree investor or investors. And that's someone who knows how to run logistics, take care of insurance, and then unload those trucks where? For what? And, your mind's eye can wander, of course, and you can try and guess. I think a lot of it is the U.S. government, the Exchange Stabilization Fund. Bissett knows gold. It was his largest holding as a hedge fund administrator. It's unusual, and it's very unusual. And so the bottom line is simply this: everything else be damned.
Prices can be manipulated for a day, but moving 2 million pounds of silver is much harder to explain away. As Andy Schectman points out here, nearly 39 million ounces. Leaving Comex is not routine trading activity because that metal exits the exchange system entirely. Once large bars leave approved vaults, returning them requires time, verification, and significant cost that casual investors would never accept. That suggests the buyers involved may care less about short-term price and more about eliminating counterparty exposure before conditions change. Next, Andy Schectman talks about why major institutions may now be validating that same message.
When you see the most well-funded and well-informed traders on the globe, from China to the other central banks to our own Comex, seeing these kinds of deliveries, that nothing else matters. I mean, as crazy as that sounds, and one other thing, you got Wells Fargo sees a potential for gold to move to 8,000 by 2027. UBS, JP Morgan, Chase, Deutsche Bank, and the Bank of America are all targeting 6,000 plus in the next 12 months. Of course, we talk about Michael Hartnett. We've talked about him before, the chief analyst for Bank of America. I told you he says 25% allocation to metals should be at the expense of selling half of your bonds. He goes on to say, Hartnett says the next phase of the decade will shift from stocks to commodities driven by geopolitical disorder, inflation, and risk. Now you got BlackRock pivoting. BlackRock is moving away from their 60-40, as Hartnett had, as has the chief analyst for Morgan Stanley, who said sell half your bonds, put it in gold. They say the traditional 60-40, we're moving away from it, increasing exposure to commodities, including gold-related assets. So you're beginning to see big institutions now quietly, because most people don't pay attention to that. That's just small print somewhere at the bottom of the financial section. On top of all the deliveries, you got the banks saying, yeah, this is where it's going. Now, people wouldn't even notice that because it got collapsed, right? But the BIS says this isn't collapse. This was structural.
The market rarely pays attention when institutions quietly change strategy before the public notices. As Andy Schectman points out here, some of the largest banks are now projecting gold between 6,000 and 8,000, while major firms rethink the traditional 60-40 portfolio. That matters because asset allocation shifts inside firms like BlackRock can influence billions before headlines ever catch up. Investors often focus on price volatility, but policy-driven repositioning by large capital usually signals a much longer cycle already beginning. Next, Andy Schectman discusses why physical ownership may matter more than simply being right on price.
This was all orchestrated by margin increases and rebalancing of ETFs. Everything is still in place, and you can see it through the deliveries and quietly through the admissions of the banks who don't want to say, well, we told you, you didn't listen. They don't want to be, where were you when all this was happening? Well, they don't want to get yelled at. We did tell you, didn't you see it?
Well, okay. So a couple of things. First off, so Andy, your point at the very high level is just an important one to reiterate, which is price is a signal. Price will be whatever price will be based upon the demands of the market on any given day. But to me, it seems like you are anticipating a future, as many of the other institutions you just mentioned, where the precious metals are going to become scarcer. And you can speculate on that, right? You could buy gold ETFs and stuff like that, and there's no reason not to do that if you're just looking for pure price speculation. But the danger goes back to the counterparty risk that we were talking about.
Sometimes the loudest warning is buried in what major banks mention only after the move has already started. As Andy Schectman points out here, price can look weak even while institutional behavior quietly confirms the underlying thesis has not changed. Investors often mistake temporary paper selling for a change in long-term fundamentals, especially when ETF mechanics distort the signal. The larger issue is that many people still treat gold exposure as a trade, when the deeper concern is whether ownership survives a stressed financial system. Next, Andy Schectman discusses why counterparty risk can matter more than the quoted price itself.
The danger is at some point in the future, these things may become scarce enough that what really matters is possession, right?
Yeah.
It doesn't matter what it says on a board somewhere. If you don't have it, you don't have the benefit of it.
1,000%.
Yeah, and that's one of the reasons why, I think your offer, in what the service you provide in general to this audience, but particularly the junk silver offer you're offering right now that helps people get in. Again, I think there's many different ways you can and probably should have exposure to precious metals, but the foundation is the physical ounces. And that's a huge reason why I have you on this program as often as I do, and why we have this relationship, is to try to help people build their own personal storage system.
Yeah, I mean, it is. And when the most well-informed traders in the world show you this through removal of counterparty risk, it's real. And the other side of that coin is that when the people who print the money are buying the one asset that cannot be printed, the central banks now own nearly 20% of all of the gold in the world. And they now hold more gold than U.S. Treasuries for the first time ever in their foreign reserves. That should tell you everything, that the deepest pockets in the world are moving out of paper and into hard assets because they see what is coming. And that's the most important thing.
A price on a screen can create comfort that disappears the moment access becomes the real issue. As Andy Schectman points out here, central banks now hold nearly 20% of global gold supply while reducing reliance on U.S. Treasury exposure. That shift matters because the institutions closest to monetary risk are choosing tangible reserves over promises from the same system they once trusted. For ordinary investors, the message is less about chasing upside and more about understanding what ownership actually means during financial stress. Next, Andy Schectman talks about why narrative control often hides this transition in plain sight.
They use misdirection of price, of narrative, of media coverage, of everything to quietly fill their own pockets. And they're the ones that are printing the paper. They're the ones who want to keep us in the system, right? But their accumulation and repossession of it, or taking it away from the two places that were for forever been used as the center of liquidity and trade in commodities and repatriating it back home, even at the expense of convenience, prioritizing lack of counterparty risk or removal of counterparty risk, rather, that should tell you all you need to know. And these are the big macro things that you have to look at and say, get it, because it pulls on your emotions when the counterintuitive nature of the times that we find ourselves in and the price doesn't move the way we think. I think price is the greatest tool of misdirection. And that is why the whole price setting mechanism scheme centered around shorting it in New York, which pushed the paper price down, and then going long in London to offset the liability on their balance sheet, where it didn't affect the price. Now, it never came back. They would just go back and forth with warrants to keep the price down. Now we're seeing, you know what? I don't want the warrant. I don't want the paper. I want the actual metal. Send it to me. That's happening here. The rest of the world, I think, in the global south, has been using the fact that we suppress the price.
Markets often look transparent until you notice who keeps changing the story around the same asset. As Andy Schectman points out here, the more revealing trend is not daily pricing, but the steady movement away from paper claims into direct ownership. Institutions can tolerate volatility, but they rarely accept inconvenience unless they believe systemic trust is weakening beneath the surface. For investors watching from the outside, that creates a gap between what financial media reports and what sophisticated money may already be preparing for. Next, Andy Schectman unravels how that pressure is starting to reshape the global delivery system.
To quietly stand for delivery everywhere else where price is not defined or affected by pulling metal off everywhere else. It's only affected in New York. That's where it's set. So if the paper gets smashed here, they can be fine. Thank you. We'll stand for delivery here, 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 and here, quietly, without the coverage of the media, and it won't affect the price. So these things are starting to accelerate when you see removal from the exchanges and really low open interest on Comex. You're getting an environment where people say, this is not the sandbox I want to play in anymore because it's rigged.
All right. I want to pull some of these points here in from the live chat. And this is sort of a potential criticism, and I just want to grab it head on. Sure. So there's a bit of a discussion here sparked by someone saying, you know, I used to hold bullion, but I don't anymore. And this fellow here said, I agree, it's not convenient. And, you know, beyond a certain size, if you're storing it yourself at home, you know, certainly silver can become inconvenient pretty quickly. And the dealer puts it in you coming and going. And this is, I mean, yes, there's truth. You're going to pay a commission when you buy and when you sell. And some people might say, okay, well, that's eating into my total return. So why would I want to pay somebody to do that? Why wouldn't I just say own an ETF? And to me, it's a totally different mindset, right?
Convenience usually becomes the selling point when the deeper debate is really about control. As Andy Schectman points out here, price can still be set in New York even while metal is being removed quietly in other markets around the world. That creates a disconnect where investors see a stable quote but miss shrinking available supply underneath that number. Paying a spread feels expensive in the short term, yet relying entirely on paper ownership can become more expensive if market access changes suddenly. Next, Andy Schectman discusses why physical ownership demands a completely different investment mindset.
Which is we're saying, look, the key thing at the end of the day, under certain circumstances in the future, is actually having possession, right? And so to pay a little bit to get it, and maybe at some point in time, if you want to sell it, to pay a little bit to sell it, if in the interim, the asset appreciates dramatically because the world wants it much more in the future than they currently want it today, what you're worried about here in terms of the commission that you're paying to get in and get out, it's nothing. It's potentially a meaningless fraction. And to use that fear of like, oh, I might give up a point or two, you know, in total on this transaction, totally, I think is you know, it undermines the tremendous potential value that you're getting from the actual physical ownership. That's my personal position, and I realize, you know, you're the party that's taking the cut on both ends, but obviously you have to because you're providing a service and you have to be able to stay in business to do that. so some might see your answer as biased, but what is your answer to that, Andy?
We're also the ones taking an inordinate amount of risk in an environment where premiums can change. You can't hedge your premiums. We were the ones that were paying $13, $14 over spot for Silver Eagles for 4 years. The ones that were paying $9 and $10 over spot for junk silver for 4 years during the pandemic. We lost hundreds of thousands of dollars at the end of 2023.
Small fees tend to get exaggerated when investors ignore the larger risk sitting underneath the transaction. As Andy Schectman points out here, paying a modest spread can become irrelevant if physical supply becomes harder to access later. Many people focus on saving 1 or 2% today while overlooking the possibility that ownership itself could carry a premium in a stressed market. The deeper issue is that convenience often feels cheaper only until confidence in the financial system starts breaking down. Next, Andy Schectman discusses the hidden business risks dealers themselves have been forced to absorb.
Hundreds of thousands, bordering on 7 figures, when the U.S. Mint and I had almost 100,000 Silver Eagles in stock that I paid $9 over spot for. And just like that, the U.S. Mint, after 4 years of being the model of inefficiency and getting bombarded by the market, saying, why is it easier to buy silver kangaroos from Australia than it is Eagles? What the heck's going on? The law says you have to print as many or make as many as is demanded by the public. Miraculously issue 4 million Silver Eagles, and I lost $5.50 an ounce on almost 100,000 coins just on the Eagles. Everything. I mean, the point of it is that what business is here to do things for free? What asset can you buy where you don't pay a bid and ask spread? There's risk, there's costs, insurance, shipping. Everything is getting higher and higher and higher, as is the risk of the
Sorry to interrupt, but if I buy from you with the intent of selling back to you at some point in the future, I want you to be in business in the future when I need to sell back to you. Right? Well, that's you have to be able to run your business without going out of business.
That's the point. And I think most people, everyone has different priorities and agendas. For me, when I buy gold and silver, I'm hoping I never need to sell it. Now, I'm not saying people need to do this. I'm just saying I hope to give it to my children someday.
Investors rarely think about dealer risk until the supply chain behind their purchase suddenly breaks. As Andy Schectman points out here, even holding inventory can create losses when policy shifts change premiums overnight. Losing $5.50 an ounce on nearly 100,000 coins shows that physical markets are not as simple as critics sometimes assume. The spread people complain about often reflects insurance, storage, and the survival of the businesses that keep liquidity available when panic eventually returns. Next, Andy Schectman unravels how the industry may be evolving to reduce some of that friction.
It's there if you need it. There are, if you're looking at a short-term in and out to capitalize on price, there are more convenient ways to do this. Now, I will say this, and I really need to be careful with this, because I've talked with you a little bit about this. I'm working with some people to address a lot of those concerns, to find less friction, to find a way to collateralize, to find things that inspire confidence and trust. The industry is moving this way. Let's just say digital forms of gold that are redeemable down to 1 ounce, and everything from soup to nuts in terms of who's storing it, who's auditing it, is it deliverable, what is the cost of storage, oh really, what is the cost of purchasing, are you kidding me? Those kinds of whoa, it's coming, right? It's coming. And it's coming across. There's many groups that are trying to perfect this. These things will be addressed, but I will simply say to you this, that from a standpoint, when I tell people that I know that own businesses, how much money we make on a percentage basis, doing almost over 900 million in sales, and you only made that? Are you kidding me? Really?
Very low margin business.
It's very low margin and a lot of risk, especially over the last few years, where premiums have literally become schizophrenic.
The next phase may not be choosing between paper and metal, but deciding how trust gets rebuilt around ownership. As Andy Schectman points out here, The market is already moving toward digital gold systems that can still be redeemed into physical ounces. That could matter because younger investors often want flexibility without giving up direct claim to an asset. The challenge is whether those platforms can truly remove the same counterparty concerns they promise to solve, especially after years of unstable premiums.